Today I'm presenting the Global Carbon Reward, and the title of the presentation is What Can Be Done to Resolve the Climate Crisis? So in this presentation, I'm going to start with describing the climate crisis, then I'll describe the policy, and in part 3, I'll focus on the theory. And indeed, I think of these 3 topics, it's the theory that's most interesting because we want to know how can we resolve this climate crisis. As you probably know, the IPCC just released the final report of the AR6, the synthesis report. And of course, this report says pretty much what we expect, given that the climate crisis has been continuing and hasn't really been mitigated over the past 30 years. And so because human greenhouse gas emissions are continuing at a very high rate, everybody is getting very worried. And indeed, we are in a crisis because it appears that humanity is unable to quickly reduce its emissions. So I really want to talk about this from a different angle today and possibly inspire you to think about the economics of climate change a bit differently. This chart, I'm sure you've seen it before. It's part of the latest IPCC report. And what it shows is global greenhouse gas emissions in the past, the black line, and then different scenarios. Of course, we have the expected trends based on NDCs, nationally determined contributions, that's implemented policies with some uncertainty. And then we have 2 other scenarios which are hypothetical. One's to limit warming to 2 degrees and then another to 1.5 degrees. And what's terribly obvious about this chart is that something new and amazing is supposed to happen today. If you look at the trend, it's actually asking us to bend the curve almost instantaneously, which generally speaking doesn't happen in most physical systems because of inertia. So if you think of our economy, our civilization as having inertia, then we need to figure out how to shift the inertia in a fundamentally different direction. So let's think about this in terms of GDP, gross domestic product for the world, and energy. Now, you probably are aware that there's correlation between GDP and energy, and that's because producing goods and services needs energy. But the correlation is actually very high, 0.997 for this period, which is very interesting. Given that most of our primary energy is fossil fuels, it then becomes obvious that world GDP would also correlate with atmospheric CO2. And you can see the correlation is very strong since about 1950, which happens to be the end of World War II and the beginning of the Anthropocene. So let's have a look at energy over time. What's interesting about energy consumption for the whole world is that it wasn't really changing very much prior to the Industrial Revolution. Indeed, prior to the Industrial Revolution, virtually all of our energy was biomass. But in the late 1800s, we discovered coal, then oil, and then natural gas. And of course, that launched the Industrial Revolution. But what's important, and what I'm trying to emphasize in this chart, is the idea that this massive increase in energy supply, it's coupled to debt. And we can see this is the case when we look at the monetary system. So the point is that prior to the Industrial Revolution, our monetary systems were based mainly on commodities, such as the Spanish silver dollar, which was used for over 200 years. And then by the time we reached the end of World War II, approximately half of the money in supply, this is just a rough estimate, I don't know the actual data, but roughly half of the money supply was debt-based and the other half was commodity money like gold and silver, or gold and silver backed. And Around the time of World War I and World War II, there was a transition out of precious metals into fiat money. And the fiat money that's being created in the world economy today is mostly created by commercial banks. So in the period after World War II, the proportion of money that's debt-based created by commercial banks as loans has increased dramatically, and currently it's over 95%. So what that means is we have a debt-based economy. And the point is, prior to the Industrial Revolution and going back hundreds of years to Mesopotamia, ancient Greece, according to historians, in those societies, they just didn't have debt. Like they had debt, but they cancelled the debt because they understood they couldn't afford to repay debt with compound interest. It's called debt jubilees. So the point here is that the only reason we can sustain so much debt is because we have abundant energy and an increasing supply of fossil fuels. Now, this is interesting because according to the International Energy Agency, our total primary energy will have to peak and even decline a bit as we decarbonise to stay under 1.5 degrees. So what does that mean for debt? Can we sustain a debt-based economy and debt-based money? Big question. This slide obviously has a lot of text. I don't expect you to read it, but you can check out the slide deck, because what I'm attempting to explain here is simply that the climate crisis is a complex problem. It has lots of features and dimensions. So the social dimensions relate to human behavior, group behavior, the free rider problem, politics, fear of taxes, the growth bias, population growth, human beings' time discount. And we have philosophical problems as well over whether to use solar radiation management. We're currently transitioning into a multipolar geopolitical environment. And philosophically, we don't even really understand how to value nature. So these are social problems, and there are economic problems you may have heard of. You're probably studying some of these, such as Jevons paradox, the climate finance gap, greenwashing, offsetting, so on and so forth. And we could talk about all these features of the climate crisis, but it would just take too long. So the point I want to make is that this problem is really complex, with social, economic, technological, and Earth system problems. And I just want to make a statement that in my analysis of the global carbon reward and the theory, it appears that the policy and the theory does address all of these issues in some way or other. I'm not saying it solves all the problems, but it does address them. And I think it puts everything into a context that makes the whole market failure more logical and somewhat easier to resolve. So let's have a look now at the policy. I'm just going to whiz through the policy. I don't have a lot of time, so I apologise if it doesn't make a lot of sense, but I've just got to get through the policy first. And if you're talking to Desiree, she heard about our work through the Ministry for the Future sci-fi novel by Kim Stanley Robinson. And interestingly, the novel is about our policy, and I'm mentioned in there by the phrase Chen's papers. I'm Chen. And the difference, though, is the policy doesn't talk about a carbon coin. We call it a carbon currency. And so the point of the carbon currency is that we're going to use it to bridge the climate finance gap to pay for the mitigation that we need to do. So if you look at this chart, this is a chart of allowable emissions for 1.5 degrees. The green is the total greenhouse gases. The dark green is CO2. According to analyses, we would need to pull carbon out the atmosphere, the dark green. And where the dark green and the lighter green zero off, that's net zero. So that's net zero CO2 at about 2050 and net zero total greenhouse gases at about 2070. And that's a scenario or a scenario for 1.5 degrees. So the cost is about 3 to 6 trillion a year additional for conventional mitigation. And we don't know how much removal will cost, but it's going to be a lot if we pay for it, at least $1 trillion a year. over the very long term. So this policy, what it's offering is to fully fund the removal under a rule called Rule 3, and this structures the whole policy. So I'll talk about that in a moment, but it also, the same policy, the carbon currency, can be used to fund cleaner energy and cleaner business through Rules 1 and 2. And by strategically funding cleaner energy and cleaner business, we can actually use Rules 1 and 2 to balance out supply and demand of energy as we strategically decarbonise. So we need to think more about Rule 3, carbon removal. That there's more details there, which I'll talk about in a moment. But let's have another look at the rules. We have Rule 1 for cleaner energy, I mentioned. That's to fund renewable energy and so on. Rule 2 allows businesses to be rewarded for reductions and also removals of greenhouse gases, whereas Rule 1 only allows reductions for energy companies, because we don't want to create a moral hazard where energy companies are polluting and also taking carbon out of the atmosphere at the same time. And Rule 3 only finances removals. Important is that the policy, the way it's structured, it only funds significant reductions and removals, called significant additionality, and there's no carbon offsetting. And the reason for that is the policy and the carbon currency will be fully funded, so we don't need to rely on offsetting, and that will solve a lot of problems because offsetting is a very risky process. In addition to these rules for managing the quantity of mitigation, we have 3 more rules to help manage the quality of the mitigation. So we have a Rule 4 to incentivize more reliable energy systems, Rule 5 to incentivize community well-being, and Rule 6 to incentivize ecosystem health. And these 3 rules, the way they're structured, is simply to adjust the rewards up or down subjectively. In this presentation, I won't have time to go into that in any depth, so we'll just move forward, and hopefully that makes some sense. The instrument, it's called a carbon currency, and it has this 3-letter ticker, XCC. It has a unit of account, 1 tonne of CO2 equivalent strategically mitigated for 100 years. So the time period's important, and the fact that it's strategically mitigated means that it's not going to be used to fund everything. It's just the important mitigation we need. So it's a representative currency representing greenhouse gas mitigation. It's not a medium of exchange, so it's not money for buying goods and services. It's not a carbon credit because it can't be used to offset. So we call it a carbon currency. It's not a cryptocurrency, and it can be traded for other currencies in the foreign exchange currency markets. So there's some really important features of the carbon currency, and I know it's a lot of information to take on quickly, but they're all really important features. So if we have a carbon currency, what do we mean by a carbon reward? Well, the currency is an instrument, a tool, but the reward is the economic value of the currency. So the way that is expressed is through what's called currency pairs. So for example, if we express the value as an exchange rate, XCC, over US dollars, then we're expressing the value of mitigation in US dollars per tonne of CO2 strategically mitigated for 100 years. And that's how it works. So the interesting thing about the process or the policy is that the rewards are expressed as exchange rates. And so if you're in Sweden, I think you're using the krona, is that right? The krona currency or something like that. You'd look at the exchange rate for your local currency. Also, these rewards, why they're different to other currencies is that the exchange rates are guaranteed over the long term, and there's a long-term floor price, which I'll explain here. So this is a chart of the global carbon reward, its value. Remember I said it's expressed as an exchange rate, so this is relative to the US dollar. And what we're looking at is the exchange rate floor price going out for nearly 100 years. And if we assume it's the year 2045, this is a hypothetical chart, if we're alive in that year 2045, what we would see is that in the history of this currency, there's a spot price. That's the value it actually traded, and it always exceeds the floor price. And the floor price will be scheduled into the future with a guaranteed period and some forward guidance for a very long time, 100 years. And why is this? Well, because this floor price, what it's doing, it's setting the value or the reward for taking carbon out of the atmosphere. But the price we're setting is such that it's the price for the minimum amount of carbon removal we will need. And the point I want to make is that if you remember the first chart I showed you of carbon removal, according to the IPCC and all the assessments, we need that removal. We won't stay under 1.5 unless we remove at least that amount from the atmosphere. It's going to cost a lot of money, you know, over $1 trillion a year, and we do not have a policy globally to fund that. So this policy will do that, and it will do it with the carbon currency in a way that no stakeholders will actually have to pay for it. And I'll explain a bit about how that works. So this is important because this will set a global reward for carbon removal for the minimum amount we'll need, and that's to avoid a moral hazard so we don't over-rely on carbon removal. The same instrument then can also be used for conventional mitigation, and I won't have time to explain how that really works because I only have, I think, another 15 or so minutes, so I'll just push through. Here, this diagram, it's trying to explain the process of money creation, and I imagine many of you will understand how banks work and central banks, but if you're not familiar with it, it can be really confusing. So the way it works is that financial institutions, they have ledgers with assets and liabilities. So in this policy, we would create a new institution called a Carbon Exchange Authority, and it would issue the carbon currency to the projects that are mitigating, but in return, the Carbon Exchange Authority will receive service level agreements, which are contracts signed by the project owners, the awardees. So that's the process. It's actually analogous to the way commercial banks create money when they're lending, but they put mortgages and loan contracts as their assets as they create new fiat currency. Here, we create carbon currency in exchange for service level agreements from the mitigation projects. When the projects have their carbon currency and they want to spend it, they just trade it for their local currency in currency markets. And corporates, institutions, and the public or anybody can buy the carbon currency, and they'll buy it because, if we go back to this chart, the value is rising, okay, over a long period of time, and then it stabilizes and it's guaranteed, so it will be attractive to many investors. This is why the market will buy it. If the market doesn't buy enough, then the central banks step in and they'll buy it to guarantee that floor. And when they do, they will create more bank reserves in whatever currency the central bank uses. Obviously, Federal Reserve works with US dollars, the European Central Bank with euros, and so on. So that's the process of money creation, and that's it. I think we're going okay for time. I am obviously going pretty quick. If it's too much information, you can grab the slide deck, but I'll just keep going pretty quick. So here's an example of how you can use a carbon currency. Consider in Africa, in the Congo, the Democratic Republic of the Congo, they have peat forests and oil and gas reserves. So there's a serious concern that the drilling and mining for these resources will disrupt the peat and the organic carbon and the biodiversity and so on. And a lot of people want to preserve the last remaining intact wild rainforests for good reasons. So what we can do is we can offer carbon currency to buy out these oil and gas reserves. Then the recipient of the carbon currency enters into a contract where they're required to then produce renewable energy, including decentralized renewable energy for communities and, of course, utility scale clean energy. And so the point here is what we're doing is we're buying out the fossil fuel resources at a value approximately equal to the profit that would have been made with extraction. And the recipient then is locked into a long-term agreement to use most of that money to build clean energy infrastructure, and then they can enjoy the profits from that. And that's how we could lock down fossil fuels and keep it in the ground. Another example is buildings. I'll go through this very quickly. Buildings are complex because of ownership and funding. It's complex when you have, literally millions of buildings. So in this case, we could offer rewards based on a price signal. In this case, a carbon intensity baseline could be prescribed and tailored to different geographic areas and cities and countries. Then the owners of buildings can voluntarily join fiscal sponsors to earn the carbon currency as they decarbonize. And this will help fund the transition. Finally, one more example, carbon removal. This is fairly straightforward because it's self-explanatory. We just offer the reward. Algal farming is an example of large-scale carbon removal technology that has some potential. So I'm not going to go into the details because I'd like to use some of this time to talk about the theory. By the way, the policy, the theory, and everything is presented in this policy working paper. You can get access to it, either individually or as a group, via our website. Just apply to do a review. So, theory. Okay, I'm going to talk about the theory now. And what I claim, my hypothesis is that the climate crisis is generally still unresolved. So the problem-solution paradigm typically is based on standard neoclassical economics, where economists rely on Arthur Pagu's theory, and they say that we need to tax the negative externality, the social cost of carbon, and the ideal tax is based on cost versus benefit analysis. And so William Nordhaus, who earned a Nobel Prize, he adopts that approach, and it's very standard. These are positive statements actually about the cause. So they claim the root cause of the problem are the choices that market actors make when the negative externality is not priced to the level of the social cost of carbon. Now, another problem solution paradigm is the normative statement around who's to blame. So people in the street, Greta Thunberg is a spokeswoman for grassroots movements, would say we need stronger political leadership, we have the technologies, but the politicians are doing too little, the fossil fuel companies and investors are too greedy, they're profiting off fossil fuel emissions, and too many people are living extravagant high carbon lifestyles. So that's another perspective. And what I'm saying is that we could move on to another problem solution based on a carbon pricing matrix, an expanded theory. And in this theory, I propose that we need to talk about a new kind of externality, I call a systemic externality. We need to look at the carbon pricing matrix, consider what it means, and this global carbon reward. So in this approach, I claim that the root cause of this problem is societal lock-in. That is, society is locked into behavioural patterns because of the economy. And this lock-in is due to the economy as a system, and it's making the negative externality worse because it's amplifying it and we're unable to correct it. Okay, so to overcome this problem, I claim we need carbon rewards to actually circumvent or bypass the mainstream economy with scalable finance for cooperation and system level control. Okay, so that was a mouthful. What is the carbon pricing matrix? This is a kind of relational diagram or epistemic theory, call it what you want, but basically there are 4 columns, and each of these columns are referring to the unit of account. So I claim there are 2 major types. We can have carbon units or we can have fiat units, which is national currencies. And then I claim there are 2 rows, sticks or carrots. So sticks are negative prices or penalties, carrots are positive prices, subsidies or rewards. So if you have this row column construct, you can then define different policies. Okay. Now, this matrix, it includes the compliance policies in the center and then the voluntary ones on the outside. So by compliance, I mean that they're enforced by governments, funded by governments. And voluntary would be a shadow carbon price, and voluntary is voluntary offsetting. Below the matrix, we have carbon credits that are used for offsetting. And then outside the matrix, we have non-state actors. You would know what all those non-state actors, businesses and citizens are doing something to help. And then state actors are governments who are doing the central planning and the regulatory work, fiscal spending and so on. So this is the lay of the land. This is the new landscape for carbon pricing. And what I find interesting about this is that it's a very convenient way to understand all the different ways you can price carbon. In that sense, I think it's quite powerful. But the real value or the real insight for this matrix is to do with the way these 4 major policies can be used to define and correct the market failure. So coming back to standard theory, we have Arthur Pigou with his taxes and subsidies. The tax is the main policy the economists focus on because they're using Pigou's theory. And the social cost of carbon is illustrated here as a yellow curve. And that's a negative value, it's a tax, estimated through cost-benefit analysis. Subsidies don't really have a clear definition in climate change because the polluter pays principle says we tax the polluter, right? Now, cap and trade is different. It uses carbon units, that's the emissions permit that can be traded, and it's based on the Coase theorem. And what I claim is that when we use the matrix, we can identify a 4th policy, I call it a carbon reward. It also uses the Coase theorem. Technically, it could be called mitigate and trade. So here we trade emissions permits, and here we trade carbon currency. Admittedly, it's more complex than cap and trade. It just is a more sophisticated policy. But here again is the shape of the carbon reward as I described it in the previous diagram. The optimization is cost effectiveness, not cost benefit. And the externality I call a systemic externality. It's not a Pigouvian externality. And I'll explain why. This chart here, you may have seen this. This is a typical supply-demand curve showing the negative externality caused by greenhouse gas emissions. And the economists say, well, tax to that level, and then it shifts the equilibrium supply-demand back to an optimum, and that's how you solve the market problem, right? That's the way William Nordhaus and most leading economists understand the problem. And over here, this symbol represents the world economy and all the market actors, everybody in it that network together. And they're described as producers and consumers, right, in this Pigouvian approach. And what I'm saying is, what's overlooked is that in this network, society or producers or consumers are locked in socially to certain behaviours, somewhat like a Nash equilibrium in game theory. So we can't actually decarbonise because to decarbonise causes too much self-harm, for businesses and what have you. So to overcome this, I claim we actually need a parallel economy, and that's structured by the carbon currency, right? It has its own rules, it's its own economy, and it's optimized for greenhouse gas removals and reductions. It's based on monetary policy because we're using a currency, and it does not create any direct costs for stakeholders in the mainstream economy. So the parallel economy, if it's based on our carbon currency, then we only need to manage the exchange rate to dial up or dial down the exchange of resources from the mainstream economy to the parallel economy. We also need to massage and develop the rules to also increase the size of the parallel economy. Now, I'm going to say a few things which those of you who are interested in economic theory, you might find this interesting. So in this parallel economy, what I argue is that because it is a parallel economy, it doesn't have the same temporal frame of reference. It's its own frame of reference. Therefore, we don't need social time discounting. Indeed, because we're creating another economy, it's not really about society per se, it's about institutions. So it's an institutional creation. We don't use time discounting. What we have is just a need to increase the quantity of greenhouse gas removal to set the price of the reward. So this is just a hypothetical supply-demand curve for greenhouse gas removal. Currently, we're at virtually zero because it's not profitable to remove greenhouse gases. So if we add the reward, which is the systemic externality, then the supply will increase till we reach the optimum of greenhouse gas removal, which is equivalent to the minimum we need to achieve our climate target. So this is the explicit price for greenhouse gas removal that structures the policy. And I showed the chart earlier. So I'm just going to fly through in 5 minutes some ideas that you might like to think about, because these ideas are really different to the conceptual models that ecological economists are using. So what I claim is that this approach of the parallel economy actually makes a lot of sense when you do a thermodynamic analysis of the carbon cycle. Now, my analysis is very technically complicated. I'm not going to explain it, and I'm not saying it's correct. It's a hypothesis, but I think it's probably correct. So when we look at the carbon cycle, what most people are doing is that they're using the bathtub model, which is stock and flow. Now, stock and flow, by definition, it does not consider the entropic effects that actually govern the carbon cycle. So when we look at the entropic effects, what we will notice, although it's not obvious, is that the biological living component of the carbon cycle has very specific properties. Mainly, they express irreversibility. What I mean by that is, like, if you look at the cells of respiring organisms, fungi, animals, and plants, those cells and organisms that respire, they do not reverse their metabolism. They do not photosynthesize. Conversely, photosynthesizing chloroplasts don't respire. Well, not very much, because they don't need to, because they're specialized for photosynthesis. So this feature is generally overlooked. And what I claim is that it's both an important macroscopic feature, and it's characteristic of living systems which are carbon-based. So it helps to define homeostasis in living systems. This diagram basically summarizes that in a very cartoonish way. So the leaf represents the chloroplast, and the butterfly represents all the respiring organisms and cells. And this is summarizing what I just said. You have solar energy coming in. It's converted to sugars as CO2 is absorbed. The sugars are then fed into the respiring cells and organisms that then release the CO2. And if you look at these organisms, they have carbon lock-in. In other words, they don't reverse their metabolism. And this is well known in biology. So this is nature's net zero. It's a thermodynamic illustration, not a biological one. And what I claim is that the same conceptual model can be applied to civilization. And it's just that the flows of energy go the opposite direction. So we have mixed energy coming in, that's fossil fuels and clean energy. CO2 is released in the consumptive economy that's producing goods and services. Noting it also has this problem of carbon lock-in, the irreversibility problem. Then if we have our parallel economy, system 2, it will take clean energy from the environment to mitigate, and it will also receive energy from the first system through the carbon reward, because the carbon reward will carry embodied energy and resources into the parallel economy, and that will mitigate for us. And basically what's happening in this system, or this solution, is we have an example of homeostasis based on two economic system types, where they're specialized for different things. The second economy specialized for mitigation, and the regular economy, the mainstream economy, is specialized for producing goods and services, or in other words, for consumption. And my point is that this is very different to what ecological economists are discussing, because they're stuck on ideas like degrowth, steady state economy, circular economy, which I argue are probably too simplistic for dealing with carbon and sustainability. This is the last slide. We have maybe 6 minutes left, so I'll go quickly. 6 minutes or a few minutes isn't enough time to explain this, so maybe I shouldn't try, but basically I'm saying when you have two economies and they're both optimizing for different things, it opens up a new approach which is quite common in the natural sciences, and that is 2D optimization, and an optimization frontier called the Pareto frontier. So you have a Pareto frontier when there are finite resources, and basically it's saying that if we maximize efficiency of the mainstream economy and we try to achieve a safe carbon budget through the parallel economy, there will be a trade-off between the two, such that we're supposed to be moving towards the Pareto frontier. And this can explain why we need to sacrifice some consumption. And the different colors of this 2D optimization, it's called a phase plane, they represent different states for the environment and the economy. So the dark grey in this curved area, that represents human civilization with a collapsed economy. It's collapsed because we don't have enough efficiency in the economy. Now, when you're in the green zone, that's a sustainable ecological system. Why is it sustainable? Because we have a high probability of a safe carbon budget. So the carbon cycle is functioning well, it's regenerative, we don't have high greenhouse gases causing global warming. Then you're in a much more luxuriant and easy environment to survive in as a global economy. Therefore, you don't need such high economic efficiency. But when you have ecological transition and collapse, then you're in a very fragile state. You need much higher efficiency to survive. But I'm skeptical that we could survive anyway in an ecological collapse. So that's what this is communicating. The reason I'm showing this last slide is because I just wanted you to think about how we could break out of this mindset of optimizing for market efficiency by just staying with the Pigouvian model in standard economics. So that's it from me. If you have questions, maybe we've got time. If you don't have time, I'm happy to take questions by email.